Good day, students. Let's start. In the previous class, I have given you the idea of share options. Please reply yes or no in your chat box. We did discuss share options concept. Obviously, we are going to revise. I just want to know yes or no. Please reply. No. We did not discuss the share option concept. Just a minute. Let me. Okay, students, basically in the previous class, we stopped here shares for nil consideration. Let me give you a little bit revision. There's a name of the concept is potential ordinary share. Potential ordinary shares. Potential ordinary shares means instrument which is not an ordinary share today, but can be converted into ordinary shares in the future. Repeat, potential ordinary share means the instrument which is not ordinary share today, but can be converted into ordinary shares in the future. For example, share options. Actually, in share options, organization, they provide options to their valuable employees that in the future, they can buy shares from the organizations. For example, let's say the company says we have given share options. Assuming the number of share options are 80,000, exercise price is assuming $20, and average market value is $50. Assuming there is an XYZ organization which has given schemes of share options to their employees, total number of share options outstanding, they are 80,000. Exercise price is 20. Exercise price means when employees will exercise this share option scheme, then per share option employee will have to pay $20 to the company. But you can see that average market value is $50. So obviously, clearly we can see there's a benefit for the employees. But logically, these options will not be exercised today. These options will be exercised in the future. Okay. Since they will not be exercised today, they will be exercised in the future. That is why we say that today it is not a potential, today it is not an ordinary share. Today share options are potential ordinary shares. They can be converted into ordinary shares. What is the logic behind this? Repeat, share options, they are not ordinary shares today. They can be converted into ordinary shares, but in the future. Okay. Now, in IS 33, we have one concept. The name of the concept is diluted EPS. Now, what is the link of diluted EPS with the potential ordinary shares and share options? Basically, while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. What will be your EPS? We called it diluted EPS. Repeat. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. Now the question arises, why do we make such an assumption? The logic behind making such an assumption is basically the objective of calculating diluted EPS is to show the dark side of the business. Obviously, when you will be assuming that potential ordinary shares, they have become ordinary. So logically, your number of shares will increase and EPS will reduce. It will be diluted. So simply, the objective of calculating diluted EPS is to show the dark side of the business to the investors, that there's a possibility that EPS can go as low as equal to the diluted EPS. Now, in case of share options, only shares for nil consideration, they will dilute your EPS. Repeat, in case of share options, only shares for nil consideration will dilute the EPS. How do we calculate shares for nil consideration? It is very simple. exercise price is $20. You will always compare exercise price with the average market value. You're not, if examiner gives you more than one value, let's say examiner has given you the current market value, examiner has given you the average market value, you will always compare exercise price with the average market value. Let's say the average market value is 50. Now try to understand. Exercise price 20 means when your employee will be exercising this option, then per share option employee will have to pay $20. But the average price is 50, which means that how much logically employee is not paying, that is $30. So how we'll calculate shares for nil consideration? It is very simple. Shares for nil consideration. Take all the share options outstanding, 80,000, multiply by the amount which we are not charging our employees, 30 upon average market value 50. So you will get shares for nil consideration. I'm getting 48,000. And let me repeat, only and only shares for nil consideration, we will only shares for nil consideration, they actually dilute your EPS. And let me repeat, while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. Let's see a question. Let's say we have profit after tax 5 lakh. Share capital. Assuming we have 50,000. Par value is $0.5. Share options. We have 200,000 share options. Exercise price is $20. Average market value is, let's say, $50. This is the only data, nothing else. So let's calculate the requirement. Number one, basic EPS, and the second is diluted EPS. See, in the entire question, we have not been given any information when shares were issued. Nothing is given. It means your weighted average ordinary shares, you can directly calculate the weighted average ordinary shares. How will you calculate? Simply share capital divided by par value, I'll get 100,000. Now these 100,000 shares, they are your weighted average as well. Why? Because we do not have any other information. And when you calculate basic EPS, in basic EPS, we consider only ordinary shares. So share capital divided by par value gives us issued shares, and they are 100,000. Entire 100,000, they are weighted average as well, because we do not have any other transaction information. And share options, their impact is only considered in diluted EPS, not in basic EPS, which means that if we calculate basic EPS, they have given us a profit after tax, which is 500,000. Profit after tax is 500,000, and weighted average number of ordinary shares, directly you will get 1 lakh. So it means basic EPS is $5. Now let us try to calculate diluted EPS. And let me repeat, while calculating diluted EPS, we assume that actually we assume that all the potential ordinary shares, they have become ordinary. And what will be your EPS? That is called as diluted EPS. Share options, they are potential ordinary shares. In case of share options, only shares for nil consideration, they will dilute your EPS. Repeat. In case of share options, only shares for nil consideration, they will dilute your EPS. We are charging our employees $20. The average market value is $50. So how much we are not charging? 30. So let's calculate shares for nil consideration. Shares for nil consideration. Shares for nil consideration. Share options. We have share options 200,000. We are having share options 200,000. We are not charging 30 out of 50. We are not charging 30 out of 50. So let me use the calculator. 200,000 multiplied by 30 divided by 50. I'm getting 1,20,000. So shares for nil consideration, they are 1,20,000. Now, how will you calculate diluted EPS? Very simple. Your earnings will remain same. That is 500,000. Existing weighted average shares are 1 lakh. Now we have made an assumption that potential ordinary shares, they have become ordinary as well in day one. So entire 1,20,000 will be added. It means 500,000 divided by 2,20,000. EPS is 2.2727. So you can see that the basic EPS is $5. But look at this diluted EPS. Diluted EPS means reduced EPS. So obviously, this is far more lower than the basic EPS. And let me repeat again. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. So whatever EPS you will be calculating, that is considered as diluted EPS. Let's see one more small question. Then I'll introduce one more example. Number one, let's say we have issued shares 100,000 on 1/1/2024. Second, again we have issued shares, let's say 50,000 March 2024. Let's say we have 200,000 shares, issued shares in September. And we have already decided nothing is mentioned. It is always considered as end of the month. Okay. Share options outstanding. Share options 1,20,000 outstanding. Exercise price. Exercise price is dollar, let's say 60. Average market value is $75. Profit after tax is $8,50,000. Year end is December 2024. We are required to calculate basic and diluted EPS. Obviously, before calculating basic EPS, we have to first calculate weighted average ordinary shares. Let us first try to calculate weighted average ordinary shares is equal to. At the start of the accounting period, we have 1 lakh shares. Now, examiner has directly given you shares. So you don't need share capital, you don't need par value. So we don't need share capital, we don't need par value. Obviously, examiner, if directly gives us number of shares. So this is what actually we want, and examiner has given us. Take this 100,000 shares. How many months? The company is having 1 lakh shares. From January till March, we have 3 months. It means first 3 months, company is having 1 lakh shares. After that, organization has issued 50,000 shares. So they will become 1,50,000. After March, next transaction is in September. Can I say from 31st March till 30th December, the time period is of 6 months. So simply 6 by 12 plus. In September, organization has issued 200,000 shares, which means that We will get 3,50,000. 3,50,000. How many months? 3 months. So here comes your weighted average ordinary shares. Let me use the calculator. 100,000 multiplied by 3 plus 1,50,000 multiplied by 6 plus 350 multiplied by 3 divided by 12. I'm getting 1,87,500. So the weighted average number of ordinary shares for basic EPS, we have 1,87,500. Now let's calculate basic EPS. Profit after tax, we have 8,50,000 divided by 1,87,500. So basic EPS, I'm getting 4.533. Let me use the calculator again. 8,50,000 divided by 1,87,500. Yes, it is 4.533. Now let's calculate diluted EPS. And let me repeat. Diluted EPS is an assumption-based value. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. Repeat, diluted EPS is an assumption-based value, and while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. The objective of calculating diluted EPS is just to show the dark side of the business. When it comes to share options, obviously share options are potential ordinary shares, because share options means they will be converted into ordinary shares, not today, but in the future. Now, in case of share options, only shares for nil consideration, they will dilute your EPS. Repeat, in case of share options, only shares for nil consideration will dilute your EPS. The exercise price is $60. Average market price is $75. So how much we are not charging? $15. It means if we calculate shares for nil consideration, shares for nil consideration. Let us first take the shares outstanding. That is 1,20,000. How much company will not charge? That is $15 out of average market value 75. So you will get shares for nil consideration. 1,20,000 multiplied by 15 upon 75. I'm getting 24,000. So logically, shares for nil consideration, they are 24,000. Now listen. We have already calculated the weighted average ordinary shares, 1,87,500. Now for diluted EPS, you can say revised weighted average ordinary shares. 1,87,500, it will increase by 24,000. So it means 1,87,500 plus 24,000, I'm getting 2,11,500. So here comes your diluted EPS. Profit after tax, we have 8,50,000. Divided by now 2,11,500. Let's see. Students, I'm getting 4.0189. Okay. Obviously, it is diluted EPS. We can see that EPS has reduced. So let me repeat again. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. So far, we have only discussed the one example of potential ordinary share, and that is share options. Now, let me introduce the second example of potential ordinary shares. Potential ordinary share means the instrument which is not ordinary share in day one, but can be converted into ordinary shares in the future. It might become ordinary, but in the future, not today. Another example of potential ordinary share is convertible bonds. Convertible bond, they are potential ordinary shares. Another example could be convertible preference shares. They are also potential ordinary shares. Now, how they are potential ordinary shares? Let me explain. Actually, potential ordinary share means the instrument which is not ordinary in day one, but that can be converted into ordinary shares. For example, convertible bond. Look at the name convertible bonds. Basically, if an organization has issued a convertible bond, if an organization has issued a convertible bond, it means that investors of the bond, investors of convertible bonds, they have options. At maturity, either they can convert the convertible bond into ordinary shares, or they can ask for the redemption amount. But since it is a convertible bond, so obviously we will say it is a potential ordinary share because it can be there's a possibility that convertible bond may become ordinary shares in the future. So convertible bond means investors, they have the option either to redeem the bond against the cash or convert them into ordinary shares. Now let me make it very simple. Wherever you read the term convertible, it is always a potential ordinary share. Repeat. Whenever you read the term convertible, for example, convertible bonds, convertible preference shares, anything which is convertible, it could be bonds, it could be preference shares. So whenever your examiner writes convertible, either bonds, convertible preference shares, so convertible means simply potential ordinary share. It can be converted into ordinary shares in the future. Okay. Now, how do we work in case of convertible bonds? Let me explain. For example, we have an organization, famous organization, APLC. Okay. Number one, issued 1 lakh shares. Issued 1,50,000 shares in March. Nothing is mentioned, it is always end of the month. 10% convertible bonds. Amount is, make it 1 million. Each bond can be converted to 40 ordinary shares per $100 nominal in 2 years' time. Don't worry at all. What are we going to do with this? We will discuss. Let's say we have profit after tax, make it 500,000. We have tax rate also, 30%. Okay. Year end is December 2024. Requirement. Basic EPS. Diluted EPS. Now let us simply first calculate basic EPS, then we'll discuss diluted. Just focus right now only on basic EPS. Obviously, we are having 1 lakh shares at the start of accounting period. From January till March, we have 3 months. So let us first calculate weighted average ordinary shares for basic EPS. Weighted average ordinary shares. So at the start, we have 1 lakh shares. How many months? 3 months. Then in March, organization has issued 150. 2,50,000 shares. Okay. After March, we do not have any other information. We have only convertible bonds. No more information. It means from March, if I go till December, so we have 9 months. Let me use the calculator. 1 lakh multiplied by 3, 2,50,000 multiplied by 9 divided by 12. I'm getting 2,12,500. So weighted average shares we are having, weighted average ordinary shares we are having 2,12,500. Let's calculate basic EPS. We have 500,000 PAT. 500,000 divided by 2,12,500. I'm getting 2.35, make it 3. Now, please, the main thing. As I mentioned right now, convertible bond is a potential ordinary share, number 1. Number 2, while calculating diluted EPS, we assume that potential ordinary shares, they have become ordinary. Now, please try to understand. Let's say, let me just bring a little change here so that let me change. Before calculating basic EPS, I just want a little change in information. I'm saying this 500,000 is the operating profit. I'm saying this 500,000 is profit before interest and tax. Why I'm making this change, you will just get to know. Wait for that. So operating profit is 500,000. Operating profit means profit before interest and tax. Okay. Obviously, then I have to bring a little change here also. So just a minute, because I've changed the data. Why we are doing this, I'll tell you. Just wait for here. Profit before interest and tax is 500,000. Okay, I've just changed the data a little bit. Operating profit means profit before interest and tax. So obviously, first you have to deduct the interest. Look at this. 10% is the convertible bond. The amount is 1 million. So if we take 10% of 1 million, it is 1 lakh. Repeat. If I take 10% of 1 million, so it means the interest which company pays, it is 100,000. So simply 1 million and then take 10% of this. From operating profit means profit before interest and tax. Operating profit means profit before interest and tax. From operating profit, if I deduct interest, we will get profit before tax. It is 400,000. Now let's deduct the tax. If we take 30% of this 400,000, we'll get 1,20,000. Here comes profit after tax, which is 2,80,000. So I just slightly changed the data. That I said, okay, 5 lakh is operating profit. Operating profit means profit before interest and tax. So obviously you have to first deduct interest. Then you will get profit before tax. Then profit before tax, we have to deduct tax to get profit after tax. Why do we need profit after tax? Because in EPS we use profit after tax. So profit after tax is 2,80,000. Now 2,80,000 divided 2,12,500. I'm getting 1.3176. I'm getting 1.3176. Okay. Now, student, let's try diluted EPS. Very important. Repeat. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. Okay. Excuse me. We have already calculated the weighted average ordinary shares, 2,12,500. So just let me write weighted average ordinary shares, 2,12,500. Now, since while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. Convertible bond, they are potential ordinary shares. Now try to read the information. 10% convertible bond, the amount is 1 million. Each bond can be converted into 40 ordinary shares. But how? Per 100 nominal. Nominal means par value. Another name is face value. Now listen, how this works, 40 ordinary shares per 100 nominal. If I just show you shares from conversion, because while calculating diluted EPS, we assume that potential ordinary shares, they have become ordinary. So first write the amount of the convertible bond. Multiply how many shares company will issue, that is 40. Against what par value, that is 100. So amount of the convertible bond divided by par value of the convertible bond multiply by number of shares which company will issue if convertible bond is converted into ordinary shares. If we use our calculators, you will get 400,000. Repeat. How do we calculate shares from conversion? First, we'll take the amount of the bonds. Convertible bond multiply by the number of shares which we will issue against the par value. Now, shares from conversion, look at this. They will increase your diluted EPS. Add shares from conversion. Add shares from conversion. So 1 million into 40 upon 100. So we are getting 400,000. It means your weighted average ordinary shares, revised weighted average ordinary shares will be 6,12,500. Let me repeat. While calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. So we made an assumption over here that convertible bond, they have become ordinary shares in day one. So that is why what we did, we already calculated the weighted average ordinary shares for basic EPS and simply just add shares from conversion. Because we are making an assumption that 8%, 10% convertible bond, they have become ordinary in day one. Okay. Now, look at this. We have operating profit before interest and tax, which is 500,000. Now try to understand the main concept. Operating profit is 500,000. Now listen. 1 million is the convertible bond amount and this is the interest rate. Since while calculating diluted EPS, we have assumed that convertible bond they have become ordinary. We have assumed that convertible bond they have become ordinary. Obviously, if convertible bonds they become ordinary shares, if convertible bond they will be converted into ordinary shares, then we will not be paying any interest because interest is paid to the debt holders, not to the ordinary shareholders. Because we have made an assumption that convertible bond has converted to ordinary shares. Since let's say there's no more convertible bond because it has converted into ordinary shares, that is why now there will be no interest. It means if I ask interest, you will say 0. So same amount becomes your profit before tax. Tax rate is 30%. If you take 30% of this, so obviously 150. Profit after tax is 3,50,000. Now simply if I calculate diluted EPS, now you will take profit after tax 3,50,000. Why profit is increasing? Let me repeat, because while calculating diluted EPS, we have made an assumption that potential ordinary share, it has become ordinary. So since potential ordinary share has become ordinary share, convertible bond, they have converted to ordinary share. So obviously there's no need to pay any interest. You will save the interest, but logically you'll be paying more tax, but profit after tax will increase. You can see that now we are having profit after tax 3,50,000. Earlier, in basic EPS, the PAT was only 280. Diluted EPS, we have a revised profit after tax 3,50,000. Weighted average ordinary shares we have calculated for diluted 6,12,500. 6,12,500. So 3,50,000 divided by 6,12,500. I'm getting 0.5714. See, earlier, the basic EPS was just 1.3176. But diluted has reduced a lot. Diluted is $0.5714. So while calculating diluted EPS, we assume that potential ordinary share, they have become ordinary. Now listen, you need to learn one shortcut. What is that shortcut? Try to understand. We have calculated profit after tax 3,50,000. And initially we had a PAT of 280. But for diluted EPS, since we have assumed that all the potential ordinary shares, they have become ordinary, convertible bond, they have become ordinary, that is why no need to pay any interest. So that is why we can see that in diluted EPS, PAT is higher. Now, if you do not have such a big data, that way you can make this profit and loss, things like that, I will always advise you have to calculate, you need to learn the skill, the method, how to directly calculate profit after tax, let's say 350. In case of diluted EPS, very simple. Please try to understand. First, you have to write the existing PAT, which you have used for the basic EPS. Existing PAT is 2,80,000. Now simply add interest saving after tax. Now try to understand. Just add interest saving after tax. Why after tax? Because we are adjusting profit after tax. So whatever event impact we want to consider in existing PAT, that has to be after tax. So add interest saving but after tax. Please try to understand now. Look at the P&L. When we made this P&L, operating profit 500,000, it becomes profit before tax. Okay. So you can see that profit has increased as compared to. Look at this profit before tax. In basic EPS, the profit before tax is 400,000, but in diluted EPS, it is 500,000. But look at the amount of tax. it is 150 and here it is 120. Since you have saved the interest, your earning has increased, so logically your tax will also increase. Now try to understand. In basic EPS, we use a profit after tax 280. In diluted, we use 350. There is a rise of 70,000. We could have calculated this 70 directly. How? Amount of the convertible bond multiply by the interest rate. Amount of the convertible bond multiply by the interest rate multiply 1 minus tax rate. Amount of the convertible bond into interest rate into 1 minus T. 1 minus T is the 1 minus tax rate. Okay. Now, please try to understand. If your tax rate is, listen to me carefully, if your tax rate is 20%, then to make it interest saving after tax, you have to multiply with 80. If your tax rate is, let's say, 10%, then you need to multiply this with 90. If your profit after tax, if your tax rate is 30%, you have to multiply this with 70. So here we have to multiply this with 70 because the tax rate is 30%. So let's see. Can I say you will be having interest saving after tax 70,000. So obviously in 280, if I add 70, I'll get 350. Exactly the same PAT. This is revised profit after tax. So student, it is highly recommended to use this shortcut while calculating revised PAT. Just take existing PAT, add interest saving after tax. This is loan amount into interest rate, and this comes after deducting the tax rate. If tax rate was 20, then instead of 70, we would have written 80. If tax rate was 10, then instead of 70, we would have written 90. So loan into interest rate into, it could be 70, 80, 90. It depends on the tax rate. So here comes your revised PAT. Okay. So I would say you should be having a really good idea about this. Just take existing PAT, add interest saving after tax to get revised PAT. So now you should be having a really good idea. If there is a convertible bond, then how do we deal with that? How do we calculate diluted EPS? Obviously, while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary. And then we'll see what is our EPS that is considered as a diluted EPS. Okay. Now let me give you one question, and I want you try to attempt, then we'll be solving together also, don't worry at all. Issued shares, we have 5 lakh. Issued 200,000 shares in April. 20% bonus issue in June. Okay. We have 40%, let's say, right issue in September. We have profit before interest and tax, let's say 4,50,000. 10% convertible bonds. 500,000. Par value is $100. Each convertible bond can be converted to 20 ordinary shares in 3 years' time. Okay, tax rate is, let's say, 20%. Year end is obviously December. Required calculate basic EPS. The second is diluted EPS. I really want you try to attempt this. Whatever you think it is right, try to attempt this, please.